Well, welcome everybody. We are recording this, so a lot of people might see it in recording land, but feel free, we'll leave our emails at the end and to ask a question if you have any. But this is the third annual CICA Student Essay Contest. Now, you might ask what CICA is. It's the Captive Insurance Companies Association, and it's the only domicile neutral captive insurance association in the world. It champions best practices, fosters collaboration among members who are risk managers, captive owners, and professionals. Now, they also have a committee called the Next Gen Committee, which focuses on raising awareness of the captive industry with future young professionals. And this essay contest is one example of what they do. Now, I'm with Strategic Risk Solutions, SRS. We are the world's largest independent insurance company manager. We provide management services to the insurance and alternative risk financing industry. We also are well aware of attracting younger people into this great profession, and we host interns, offer a program where we send students to various captive conferences, and we also partner with CICA in sponsoring this essay contest. Now, I'm Derek White, and I've been part of the captive industry now for over 30 years, and I can say it's a great industry. We get to work with smart people solving issues every single day. And you can see on the screen, couldn't join us today, but Dan Toll, the president of CICA, and Brady Young, who's the CEO of Strategic Risk Solutions. Also joining, you'll see in a minute, is Jonathan Stark with SRS Advisors, and Laura from our South Carolina office, who will be one of the mentors. And I'll introduce them and show pictures in a little bit minute. So what is this all about? This is the student essay contest. And what we're looking for is two-person teams of college, risk management, insurance, or business students to write about one of the two topics that we provide them. And the idea is to learn about captives and apply what you've learned about captives and how a captive could provide a solution to one of the two case studies that we're going to present. The rules, the official rules will be on the CICA website, and that's cicaworld.com. And I'll present that again at a little bit at the end. But really, it's working teams of two, 10 pages maximum. And there are special rules. It has to be in Word. I believe it's double spaced. There's a few rules, so you can't get around making 10 pages out of, a paragraph. It can't be published prior, and the judges aren't by me. It's all judged by a team of CICA members. And see the CICA for the complete rules. Now, why would you really want to do this when you're kind of busy trying to graduate? Well, first of all, there's a cash prize involved, up to $2,500 for the first place, 15 for second, 1,000 for third place, and free registration at the CICA conference, which is Tucson, Arizona in early March. So some of you that might be, let's say in Pittsburgh or Philadelphia, you might enjoy a little trip to March, to Tucson in early March. The top three teams will present at the CICA conference, present their papers, and the winning entries will be published in the Captive Insurance Times, which is a good paper. So you could, before you graduate, actually have a cash prize, speak in front of a large group of insurance professionals, and also get published. The timeline is here. It's pretty quick. This is the first kickoff, the live webinar. We need intent to participate by December 10th, which I think is Friday. And then the next thing to remember is really quickly find your partner, start working on this, and submit the essay by January 7th. So it's really something that could be done over the holidays. And CICA will be judging them and pick out the top three finalist teams. Now, during February, the top three teams will work with our three mentors to fine tune the essays. They might go back and forth maybe 2 or 3 times just to fine tune them. And then CICA will present name the first, second, and third place teams, and then it'll be published at the Insurance Times later on. So that's the essay contest, and we'll give you a little kickstart to talk about what captive insurance companies are. And then I'll introduce the mentors, and we'll present at the end what the case studies are. Now, Jonathan Stark is going to do the captive basics part. Jonathan works with our SRS Advisors, which is our unit that focuses on captive formation and special projects. Jonathan, you've been with SRS probably about 5-7 years, and I don't know, how many captives have you formed?
Well, yeah, I don't know, just over 5 years now with SRS. In terms of captives formed, probably 50 over that time period. For new formations, obviously we've redomesticated lots of captives or taken over lots of captives from other managers. But in terms of new formations, probably 50 plus over the last 5 years.
Okay, terrific. So walk us through captive basics.
Sure. So, at the fundamental level, a captive is basically an insurance company formed by a non-insurance entity to insure the risk of that non-insurance entity. So to make it super simple, Walmart forms a captive. Walmart's not in the business of insurance. The captive's sole purpose is to insure the risk of Walmart or Walmart's affiliates. So they're not insuring third parties or, everyday consumers unaffiliated with Walmart. It's an insurance company formed only to insure the risk of its parent or its parent's affiliated entities. Some of the characteristics of a captive are a licensed insurance company. So this is actually licensed by an insurance regulatory body in a U.S. state or a country outside of the U.S. It's regulated under special legislation regulating captives. So there's laws on the books of each state or each country that regulate the formation and operations of traditional insurance companies and then captive insurance companies. Captive insurance companies are a little bit different in that the regulatory body deems them sophisticated buyers of insurance and therefore does not regulate them as stringently. Because really, if the captive goes belly up or insolvent, it's only going to hurt the owner as it's only insuring the risk of the owner. And then it's generally licensed only in one domicile as opposed to traditional carriers that have to get licensed in multiple domiciles to do business. Next slide, please. So when I said the definition of a captive, I was really referring to a pure captive. So a pure captive is what I described. It's wholly owned by one parent company, and then it insures the risk of the parent or the parent's affiliates. There's some nuances that we'll get into later on as you begin to write your essays, but at a high level, let's stick with that definition for now. In terms of other types of captives, there's also a group captive, which sort of operates more like a traditional carrier, but it's still owned by the members of the group. So rather than one entity owning an insurance company and that insurance company insuring the risk of that one company, 10 companies that are all in the same industry, so maybe 10 construction companies, each have an equal ownership in a captive, and that captive and sort of pools the risk of those construction companies. And by doing that, they get economies of scale, they get group purchasing power, and they may not be big enough on their own to self-insure, but when they can share risk across those 10 construction entities, they're big enough to sort of get the economics of a large entity, but share risk and mitigate volatility and claims across all of those different entities. With group captives, typically each of those 10 groups will be an owner of the captive or a shareholder of the captive. And they're structured kind of uniquely in that there's typically 3 different layers where the construction layer 1, which is called an A fund, is typically where the construction company insures its own risk. It's kind of like a deductible. Layer 2 is where all the 10 construction companies share risk. And then layer 3 is where they buy traditional insurance. So that's the typical structure of a group captive. Next slide, please. So why form a captive, build versus buy? Typically, people are looking to increase control by forming their own captive. So increase control over their total cost of risk, increase control over coverage, but primarily it's to become less reliant on the cyclical nature of the insurance market. So obviously, right now the insurance market is very hard, meaning very expensive. So there's lots of captives being formed. By forming a captive, you can rate your insurance costs based on your own loss experience versus the broader market conditions driving the price of insurance. So it allows you to stabilize your total cost of risk based on your own experience versus the broader market, which is really where that control is critical. Next slide. So what I do on a day-to-day basis is I conduct feasibility studies for companies that are interested in forming a captive insurance company. So typically a broker will come to us and say either one of 2 things. This client's interested in a captive, or we think this client needs to be interested in a captive. Sometimes there are other motivations driving it, but the first thing we do is identify the problem or opportunity. So, for example, this company had a 50% rate increase, but their losses have been, pretty static or operating at a favorable loss ratio for the last 5 to 10 years. Broader market conditions are driving their premium up, and it just doesn't make sense. So once we get our hands around the particular problem or opportunity, we sort of work to quantify that. So is that actually the case? So we look at their historical losses, we come up with a loss projection and compare that against the premium they're paying to the market. So we work to quantify and make sure that opportunity or problem or hypothesis is actually correct. And ultimately what the feasibility study is going to tell you is whether or not the economics make sense. So would it make sense to structure a program where that entity retains more risk, either through large deductibles or through fronted reinsurance versus buying traditional insurance from the market? If they form a captive, how much capital will they need? What are going to be the operating expenses? What's going to be the premium? From a regulatory perspective, how can they write it? So, like I said, does it need to be fronted such that either from a regulatory body or contractual requirements is going to require an A-rated or admitted carrier to actually write the policy? Can the captive write direct? What are the implications of that? Can the captive achieve insurance company tax treatment? Probably getting past Captive 101, but those are some of the considerations that we think about. Next slide. So I was touching on this a second ago, but basically there's two structures in how the captive can, or how the insurer can place the risk with the captive. Either it's a direct policy from the captive to the parent company or to the insured, or it can be fronted by a traditional insurance company, let's say AIG. So the insured or the owner of the captive would buy a policy from AIG. AIG would then send all or a portion of the risk to the captive via a reinsurance agreement. And the reasons you'd want to front in certain instances, again, are for regulatory requirements, i.e. comp and auto liability, or for contractual requirements like general liability or other, when you do business, certain counterparties want to make sure you have a certain type of insurance coverage. So that's what I mean by contractual requirements. So in order to meet lending covenants or landlord requirements or the like, you'll have to have A-rated paper. There's a pretty big difference in the economics when you look at the two deals. Direct is way more efficient because you're not picking up the frictional cost of a front company. So fronting companies are typically going to charge fronting fees. You're going to pay higher taxes. And then also the big deal with fronting companies is they're going to require collateral. And that sometimes kills the captive deal just because it changes the amount of initial capital needed to start the program. Direct has its own set of issues. Direct, in some instances, can make you subject to self-procurement tax, but it is much more efficient to write a direct policy. So I would say when you look at the SA problems, I would just study whether or not that coverage can be written directly in a captive or it needs to be reinsured is just one consideration. Next slide, Derek. So another alternative to this issue that I'm bringing up with regard to liability coverage is a risk retention group. So a risk retention group is allowed to go direct. It can only write liability coverage, but it's allowed to go direct as opposed to those instances where you need a front that I was describing on the prior slide. The nuance here is that in an RRG, every insured has to be an owner, every owner has to be an insured. So it's kind of like a group captive in that sense. There's a couple other nuances with an RRG. They actually have to get approved in the states in which they're writing in, more like a traditional insurance company. Which can be a cumbersome process. They're certainly more expensive to run and regulated more like traditional insurance companies, but they can write, for example, auto liability coverage directly, which can be a benefit for certain groups. Next slide. So that's, yeah, I'll hand it back over to Derek. That's all I have for now. I'm available to answer questions. Um, I'm sure you guys have all sort of been introduced to captives in some of your classes. Maybe it was just a small portion of a class. Maybe it was a larger portion of a class. We're not really sure where your knowledge level is, but we're happy to help and answer questions along the way. So thanks, Derek.
Awesome. Thanks, Jonathan. And if you want a longer presentation, Laura and Jesse from SRS did a really good webinar. It was back in 2019, but it's still extremely relevant. And you can view the recording by clicking on that once we get.
So I can give a quick overview. I've got the slides from an email, so I can just give a quick overview of what the two case studies were.
Okay.
I believe that the next, so if you do want a deeper dive into captives, you can certainly register for the Captive 101 webinar that's on SRS's website, or feel free to reach out with additional questions. But this year we did narrow down the competition to two different case studies. The first one is for the American Cannabis Association. So this is a hot topic currently. So not only in the insurance industry, but across many industries, as everyone is learning to navigate the intra and interstate rules and regulations. And Jonathan, if you do get a hold of Derek, let me know, because if we're going to record this, we might need to just redo this completely.
Yeah,
But
will do.
okay, but because I can't see the screen or anything, just speak up, because I won't be able to see you trying to interrupt me. So anyway, back to the first case study. So as the legalization of the sale of medical and recreational marijuana increases amongst a number of states, the investment opportunities as it relates to the distribution, the production of various products is also on the rise. And since marijuana is still classified as a Schedule I drug at the federal level, there are many operating challenges that have arisen, such as finding banks and insurance plans that will provide services and insurance. So examples of the insurance plans needed but can be difficult to find in some states are general liability, product, auto liability, workers' compensation, and even cyber. So what we're asking the students to do is put together an implementation and formation plan. What would be the optimal structure of the captive to best suit the needs of the ACA, the American Cannabis Association? And then the second case study is the Craft Brewery Association. And CBA is an existing association looking to increase benefits to its current members through a medical stop loss plan, in addition to future plans for adding voluntary benefits. They currently have over 6,300 members across all 50 states. Each brewery typically employs 25 to 75 full-time folks, and then they do have part-time and seasonal employees to consider as well. The captive funds have already been raised and set aside for the feasibility and formation, the implementation and formation of the captive vehicle, should they decide to go that route. And so what the case study is asking is for the students to identify if and how a captive solution is the best course of action for the CBA, for the association.
Thank
So
you.
you're welcome. Do we have Derek back?
He's Derek, you're on mute. We can't hear you.
Let me try again. Okay, I still cannot get into Teams.
There you go, Derek.
Okay. I'm sorry, I've lost all internet for some reason. I am back though, and let me share the final slide. Thank you, Laura, for continuing on with that. It looks like the recording kept going, so we'll be able to share the whole thing. It'll just be without my pretty face for a piece of it. So thank you very much. We're almost done. Let me just share a screen for one more important. Okay, when things go wrong, they really do. There we go. Okay. I think we've got the big thing. The website for all of this will be on CICA, which is cicaworld.com. And if you want to get really clever, it's just student essay contest. Will take you right to the rules, the details, everything you need, and it will be a copy of this recording as well. And you'll also see the prior year finalist essays, all three of them. So you can really get a good feel about what this looks like and maybe what they do. You might be a little scared after hearing Jonathan's 101, maybe 301 presentation. Keep in mind, he's had 5 years of experience and we're telling you an awful lot. You can, make it much simpler and have things work out really well. If you have questions, we'll also have Ione, who's with CICA, and email address, and you can ask her any specifics, and I'm willing to help. And I can also, if you have any issues or want to talk to somebody else, I can address some of the captive issues. Jonathan offered to be a resource as well. Certainly the professors, as I said again, I think there were about 10 entries last year, and not one of them talked with the professor, as I believe. So, that almost should be the first start to help maybe craft which kind of captive you might form to solve one of the two case studies. And then you're really cutting the amount of work you have down because you already have a good basis of it. And I can also hook you up with various regulators, CPAs, attorneys that would be glad to help you as well. Okay, and that's it. So let me go back to ending that. So I don't know if there's any questions. I don't think there's any in the chat box yet. There's only a handful of people on this call because I know a lot of them. I think Mike said Temple has exams right now, and so I'm sure a lot of students might as well. But we've kept it to 25 minutes, so hopefully people will see the recording in the future and log in. Again, it's should be a great opportunity, and what a better way to put something on your resume than be a finalist in a big contest like this. So thank you, everybody, and thanks, Laura, for continuing on when I call us drop.
Yeah, sorry for the technical difficulties.
Yeah. So, okay.
Sign of the times. Okay, well, yeah, please reach out with any questions. Thanks, Derek.
Good. Thank you, everybody.
Okay, thank you, Derek. Thank you, Laura. Take care.
You're
Bye-bye.
welcome. Bye-bye.